Hello everyone, how are you all? I hope everyone is fine and rocking. Okay, last time we have done the basics of the financial management, right? The basics were very clear. I hope it's very clear for you all. Now let's move on to the next chapter, that is capital structure decisions. What we'll be doing, that we'll be understanding the basic things regarding EBIT, EPS and all, and then we'll move further with other chapters. We'll not just go in line with the ICI material and all study material, but we'll be picking up the topics which we think it should be going in this flow. Okay, and now let's see that this is the fifth chapter in our study material, that is the capital structure decisions. What is the capital structure decisions? We have already seen in the previous class. That comes under the financing decisions, right? Last time we have discussed what comes under the financing decisions, the decisions regarding what from where should we collect the funds, and what should be the capital base. If I am starting a company, how much I should be asking from the equities, and how much I have to be asking as a debt, how much I have to be taking in form of the preference shares. So that is the base of the thing, the company where you will be inviting the funds, you will be collecting the funds, and in what what in and with what proportion you have to actually get the funds. Okay, now to understand this financing decision concept, the basic capital structure, actually it is the basic capital structure which is actually decided. We need to understand two things in this chapter. Okay, that is EBIT EPS analysis and capital structure theories. Okay, if you it's like the fifth chapter, that which is the capital structure decisions, that is nothing but financing decisions regarding the capital structure. Therein, this whole page is the overview of whole chapter. What you will be learning in this whole chapter is the only this thing. Whenever you're starting any subject, first make the list of the subjects which you have to be looking at. That's nothing but the index. Okay, and whenever you're taking a one topic, one particular chapter, you need to put an overview of whole chapter. If you understand what you will be going to learn in the future, you'll be comfortable with getting ready with next chapters, and your mind will be thinking for the things related to that. Okay, let's start with EBIT EPS analysis. What all it is? Okay, what will happen to decide the capital base, to decide the capital structure of the funds that we are getting into the company? We need to do an EBIT and EPS analysis. What is EBIT EPS analysis? EBIT is earning before interest and tax. EPS is earning per share. Okay, if we start from EBIT and we end up at EPS. So, in this EBIT EPS analysis, the first thing that we'll be focusing is optimum capital structure. Like, you would require a capital, right? That capital might be from equity shares or the preference shares, okay? Or sometimes you may take the loan, that is nothing but debentures or some loan funds and anything from the banks and etc. Okay, making a base of capital structure is not a big deal. You can just take off the money without any thinking, like I'll take so much from loans, I'll take so much from equity, I'll completely take equity, I'll completely take preference. It is a lame thing that you just take off all the funds in the equity, yeah, all the from the debts. That's not the way you have to be deciding. You have to be deciding that proportion based on the EBIT EPS analysis. What is optimum capital structure? Optimum capital structure means that you have to take the debt in such a way, you have to start with your base in such a way that you earn the maximum EPS. EPS is what? It is the earning per share, what the shareholders will be getting, the whole earning divided by number of shares. If a person is holding one particular share, how much he'll be earning the EPS behind it. Okay, so that is what the optimum capital structure is. You have to be looking out the opportunities what are available in the market. You have to be calculating the from EBIT, you have to be calculating the EPS, and you shall be knowing that what is the maximum EPS. Okay, fine, this is the okay, fine, if I am taking like half 50% as debt and 50% as equity, then my EPS is maximum. Okay, fine. If I'm taking completely the equity, then my EPS is higher than the other options. So at that, that moment, that checking of the maximum EPS is the optimum capital utilization. Optimum means to the extreme, to the fullest. Okay, next thing which we will be learning in EBIT EPS analysis is break even point. Okay, break even point is what, where EPS is 0. What you will be doing here in, you will be starting, you'll be going backwards. EPS, you'll be making it 0, and you'll be calculating all the fixed interests, like you'll be having like fixed interest, like debentures have a fixed interest of some percentage, right? And also the preference shareholders will also have a fixed number of dividend. It's like you don't want to be in a position of a loss or profit. Okay, so like maximum how much you have to be earning the EBIT, how much you will be earning the EBIT, so that your EPS ends up at 0. That is the break even point. Okay, now we'll be seeing the problems, each and every problem cases, each and every case, for each and every case we'll be seeing the problems now. Okay, indifference point is what we have to check the EPS of, there are two options that are available. Okay, either you raise from equity, either you raise from the mixture of the equity and debenture, or you can raise through debentures and preference shares, right? So there are many other options available. So we'll be checking that in, like, sometimes it happens, right? Either you take it from equity, or you take it from debentures, or you take it from debentures or equity or somewhere. The EPS of any two plans, any two options, it gets same. If it's equal, then we will be saying that indifference point. Indifference means what, we will be taking any of the option, we are getting EPS, so we don't care about what you'll be taking this thing. Okay, once EPS is same, we will be considering any option, this or that, not a particular one option. Okay, so these are the topics that I'll be covering in EBIT and EPS analysis. This is one of the tool wherein you'll be seeing which capital structure is the better, is the best for the company. Okay, here and also we have like two options. First we'll be seeing for the new companies. Okay, for new companies we'll be seeing, and for existing companies, right? They'll be like, the difference in the problem will be like for the number of shares. Okay, new companies for the new ventures, and for existing company the problems will be based on this thing. Okay, so new companies, they are newcomers and they have to start the base, and everything will be from the scratch. Existing company will be having some equity, they have already raised some amount, but then they're expanding the business. Then we'll do all these analysis and try to collect the funds in that way, in that proportion. Okay, we can easily find out the value per share, market price of the share, using the EPS and PE model. Okay, price earning ratio. Now what next approach we'll be seeing in this capital structure, that is capital structure theories. Okay, here what it says, for some capital structure that will surely affect the value of your company. Okay, so they are like many people who have done their own theory, after research, thinking and all, and doing a research, they have they have reduced down to these two theories. Okay, that is again these four theories belongs to this capital structure relevance theory and capital structure irrelevant theory. Basically, the capital structure relevance theories are the one, like, where the person have done the research and found that the market price, the value of the firm, the value of the company will affect. Okay, if based on the capital structure. Okay, what kind of debt you are taking, what is the cost of capital, and everything you will be considering in the capital structure, and that will surely affect your value of the firm. Okay, that means it's a relevance theory, capital structure relevance theory. Okay, so in that capital structure relevance theory, there are two approaches, that is net income approach and traditional approach. We will be dealing with each and every topic in detail. Okay, we have to be doing the problems in detail. Okay, then you'll be very much perfect with this topic. Okay, it's very easy. Will not take much classes too. Okay, next is capital structure irrelevant theory. Irrelevant theories are those wherein whatever you're taking any, your capital structure mix, whatever you are taking, whatever you be your base of the capital structure, either from the debt, either or from the equity, or from the preference, or from the debentures, or from the loans, anything, that doesn't matter. Your firm value, your company's value will be same, the market value of the company will be same all through the thing. Any of the structure you pick, any of the combination you pick, you will be having the same value of your company. Okay, this is what irrelevant theory says. So in this irrelevant theory, there are two approaches, that is net operating income approach and Modigliani Miller's approach. These are the two persons who have actually, gone through this, made up the theories, making some assumptions. There are so many assumptions in it, like in physics we used to do, right? Keeping some things constant, keeping this as constant, we'll be having this equation the same way they have done their own this thing for, they have assumed some hypothesis, and they have actually showed the impact of capital structure on the value of the firm, taking the base as, it is irrelevant, and at the end they'll be proving how the things will be actually shown. Okay, we have to be for understanding all these things, we'll be seeing each and every topic in detail, every in each of the lectures. Okay, all through the while I was saying that EBIT and EPS analysis, EBIT and EPS analysis, then what is actually EBIT and EPS analysis? How can you people relate to it if you are new to this? Okay, if you haven't studied this EBIT and EPS in your CA foundation, because in your CA foundation you would have accounts, right? In accounts, maximum you have ended up doing accounts and ledger, and maximum the financial statements. Okay, so therein you don't know how to connect it back, right? Okay, now check this pro forma. You will be having, you will be having sales, right? Generally, what in the income statement, you will be having trading account and all, what you used to do, you will be having sales, you will be deducting all the variable costs. Okay, all the variable cost, as in what, all the costs which are like a labor cost, material cost, all these costs will be removed. Okay, after removal of that, you will be getting the contribution. Okay, herein you'll be deducting the fixed cost from the contribution. Okay, there are fixed costs like what? Fixed costs are the perspective of the production, your cost will be same all through the year. That is called as the fixed cost. Even your production is zero, your fixed cost will not be zero, your variable cost will be zero, your sales will be zero, but your fixed cost cannot be zero. That will be the basic minimum cost that you will be incurring. Now, the best example is the depreciation cost and all. That is the fixed cost that will be occurring every year. So that reducing the fixed cost, we will be getting the operating profit. Okay, operating profit is what? Operating profit is you are getting the profit from the business which you are running. That is operating profit. Okay, the operating profit is also called as earnings before interest and tax. You should be getting used to this word EBIT. Okay, earnings before interest and tax. Okay, from the name itself you can make out that earnings which are before interest and tax, you are yet to deduct interest and tax from this. Okay, now let's go further. We will be deducting the interest on long term debts, whatever the long term debts it will be debentures. Okay, it will be the bank loans and all other secured or unsecured loans. Okay, these are the loans. The interest on these loans will be deducted from here. Okay, whatever is the interest for that particular year, from when we are taking in all, we are keeping in our business, right? So we need to pay some interest to that, so we'll be deducting from EBIT. Now what you can say, interest is deducted from earnings before interest and tax. Interest is deducted, so what you will be left with? EBT. I got cancelled. EBT, earnings before tax. It means that these are the earnings which are before tax. Now what you need to do, you need to cut down the tax. Okay, less tax, wherein you'll be given the tax rate and all, you have to be deducting the tax. you'll be deducting the tax, and you will get, after deducting the tax, you will get what? Earning after tax. If you get a after tax figure, right? Now what are your obligations are, if you have a preference shareholders, you have taken the loan, I mean you have taken the capital from the preference shareholders, then what? We have to be giving them the dividend, because they have allotted for preference shares. You need to be giving them the dividend before equity shares, right? So we will be deducting preference dividend. Basically this interest will be fixed, like fixed percentage will be there for these interests. Like bank loans will have some to 10%, debentures will have 12%. It depends on the market and all. It depends on which type of debentures or loans you're taking up. Okay, and the preference dividend will be, it's an agreement between the company and the shareholders, right? So they'll be fixing some particular amount of dividend, 10% or 12%. So anyhow they'll be there, the percentage will always be there. Okay, so once we deduct the preference dividend, we will be left with earnings available for equity shareholders. As I already said, here we are completing all our obligations for the yearly obligations, and we are getting to the point where we are having earnings which are available for equity shareholders. Now this is our money. Imagine, like you are an equity shareholder, you will be concentrating on what money you are getting. Okay, this is your own money after all the deduction of all the other expenses. This is actually your profit which you have earned. Okay, you cannot just simply say that, okay fine, operating profit is this much, okay, this is my amount. You cannot say that, because you have so many deductions. You have to give to the interest, okay, you have to give to all the money lenders, you have to be giving to the government, I mean income tax officials, preference shareholders and all, everything. Now what amount is left is your own money. Okay, I mean, I am telling you, if you're an equity shareholder, from that point of view, this is your own money. Now, what happens that this whole money belongs to all complete set of shareholders, right? All the owners, all the shareholders of the company. How much amount does that one share investor will be getting? That what I need to do, I need to divide it by number of equity shares, right? Usually what we do, if we want to get the capital, we'll get the capital and divide the capital by amount which you are actually asking with them, right? Here in what is happening, you have your earnings, complete whole company's earnings are there. You want one particular unit's earning, one particular equity shareholders earning. So what you will be doing, because you want one particular thing, you will be dividing by number of equity shares which you have raised. Divided by number of equity shares, you are getting your EPS. That is nothing but the earning per share. Now if I have one share in this company, my particular earning per share will be this much. If I have 10 equity shares, then I'll be having 10 into so much amount. Okay, so that is the earning per share that which is available with me. Now what happens, on basis of this, we will be checking out, on basis of this, we started from where? Here, EBIT. We are ending up where? EPS. Okay, now this is the time where we will be seeing that which if EPS is optimum or not. If it is optimum, we will be opting that particular plan. This is for only one thing, right? We'll be having many other plans, so we will be seeing accordingly when we do the problems. Basic thing you got about it. Now what happens, we are talking so much about, after EPS, the next thing which you have much heard is the market price per share. Obviously when I will be selling the share in the market, which I already have about the company, or I want to know the market value of the shares of my company, what I have to be doing, I have to be knowing the position in the market, right? I cannot just say that, okay fine, my company is earning so much of EPS, I have the face value of 10 rupees, but I'm earning the EPS. You just simply cannot add your EPS to your face value. You shall be knowing the market price, I mean what actually your reputation in the market is going on. So that thing, that particular market value, depending on the market, depending on the competition, everything, one ratio is calculated, that is called as price earning ratio. Okay, for how much of earnings, you know what price you'll be getting. That's nothing but EPE ratio. So you will be having some amount of PV ratio, like it will be 7 times or 8 times or 10 times. So time, it will be in the times. Okay, so what will happen if you want to know the market price of your share? Then you need to multiply the PE ratio with your EPS. This is my position in the market. 10 times I have my, if I'm putting on 1 rupee, I'm earning 10 times. Okay, so actually it works that it works that way. It means that at, if you are having one particular share which you have bought in 10 rupees, but now eventually because of the company's good reputation in the market, we will get to know our MPS, market price. I have to sell my share now. On what price I'll be selling out the shares? I will be selling shares currently at market price. So this is very important for any of the shareholders to know what they have invested is actually worth or not. This is the MPS. So we have started from the sales and we have ended up to MPS. Right now you can actually relate to, accounts and, financial management. Now you can completely relate. One more thing is that sales less value or variable cost is the contribution and fixed, all these things till here. Okay, making of these things till here, it's a responsibility of the cost accountant. Okay, and from here till the end, till you get the EPS, it is the responsibility of financial manager or financial accountant, you can say. Okay, so this is what the complete statement of EBIT, EPS and MPS analysis. Now, the points which we have to remember while we are preparing the EBIT and MPS statement is that we should be knowing some of the criteria, right? That is price earning ratio, PE ratio, what it is. PE ratio, if we want to calculate, it will be market price per share divided by EPS, because we have already said that EPS into PE ratio is nothing but MPS, right? So if we want to know PE ratio, we'll be sending this EPS down. So MPS divided by EPS is nothing but the price earning ratio. Okay, and next, total number of equity shares. See, for suppose your company is not a new company, you are started, you're already a running business, you're already an existing company, and you are inviting new ventures, you are inviting new shares. Then number of equity shares will not be just for new shares, right? Obviously, that EPS which we are calculating there, it's not just for new shareholders, it is for both old and new, existing and new share. So now total number of equity shares will be existing shares plus new shares. Okay, new equity shares, how shall we, this will be already given in the question, but how shall we calculate this new equity shares? There are some of the problems where, the complication is given here, and if you go wrong here, your whole problem goes wrong. What will be the issue price of a share? You are issuing that particular price. Face value will be obviously 10, the current market price is going on. Okay, issue price will be depending on your market position. Okay, suppose issue price is 25 rupees. Okay, 30 rupees, issue price is 30 rupees. But what happened while issuing the shares? You will be having, some of the cost directly right away. Did you go and you cannot announce in the mic that you're issuing at 30, who wants to buy, nothing, right? You need to be raising that amount. There are so many procedural aspects, there are so many other aspects that you need to be incurring the expenses for that. Okay, you need to raise an IPO and all. Let's suppose the cost of issuing will be 10 rupees, imagine. So what is the net proceeds? Matlab net proceeds here. So issue price is 30 minus 10. I mean, issue price is 30 and this cost is 10. You will be getting 20 rupees as your net proceeding. Next is net proceeds from the shares. What is net proceed? We have just now discussed that issue price minus the issue expenses. Issue price is 30, issue expenses is 10, and you'll be getting 20 as the net proceeds from the shares. This is the actual proceedings which will be collected in the form of additional funds. Okay, I have discussed all the, EBIT, EPS and everything. I just said you about the statement of it, how it is calculated actually. Now let's see how real life experience, how to be used. Okay, and why in capital budgeting it is used, capital structure, sorry, why in capital structure it is used. So let's see selection of a plan on the basis of the EPS or MPS of the new company. Okay, we are just doing with the new company, we'll be doing problems related to that. In the question, they'll be giving that you have to raise so and so amount, the equity amount. So there are so many plans available. Anyhow, in all the cases, don't forget that with new company, equity shares will be issued. Unless and until you issue the equity share, you cannot start up the business. You cannot completely go and ask for the debt. Okay, from this thing you don't have any base, you'll ask that means matlab it is totally null and void. You will be having many alternatives available in the market. Okay, you will be issuing the basic equity shares. Okay, but what happens, no, the challenge is that complete amount, suppose you have to raise 100 crores. I just said you the example previously. If you want to raise 100 crores, you cannot, you know, you might raise that 100 crores, but depending on the EPS or MPS, which one is giving you the maximum benefit. Okay, you have an option like complete equity. From complete equity you will be issuing, right? Or other option is debt, but not completely. Trust me, you need to issue the equity first, and then, so first suppose 50% equity, 50% debentures. Okay, now preference is there. So imagine in preference also equity is available. Okay, without equity you cannot just proceed further, any you cannot even start up a business, right? The equity shareholders will be there. So for you, like 50% from the preference and 50% from the equity, or all the three can also be there. There are so many alternatives available for you to issue the, you know, issue the funds, issue the funds. Now what will happen based on EPS MBS? How will you check whether it's an optimum, it's the best one? Okay, best combination. What you will do, you will start from EBIT, take for the equity and all. For EBIT will be same in all the alternatives, all the cases. Okay, less you'll be deducting the interest in equity. You will you be having the interest? No, you will not be having interest. In debt and equity combination, will you be having the interest? Yes, you will be having, because you have to pay for the loans. Okay, in preference you'll be preference and equity, is there anywhere debt available? No, you will not be having the interest, right? Interest amount to deduct. So you'll be like calculating the earnings before tax, you'll be getting earning before tax, and you'll be deducting the tax, right? At some percentage, whatever the percentage is given, whatever is going in the market, you'll be deducting that percentage of tax. Okay, what happens here, if you're deducting the tax completely, this amount slashed down to the earning after tax. Okay, next, you have to be deducting preferential. You need to mug up all that, you know, statement, you know, it should be on your tip of the tongue, that EBIT minus interest is EBT, minus tax is EAT, minus less preference dividend is earning available for the equity shareholders. So that should be your preparation. Okay, preference dividend will be given after deduction of tax and everything. So preference dividend, will it be here in equity? If you're raising the whole amount through equity, will you be liable to pay the dividend here, preference dividend? No. Okay, here in debt, you're giving some amount, some portion to the debt, you're raising from some portion from the debt and equity. There's no chance of preference, right? So there'll be no preference dividend. But herein you have preference and equity, you will be having preference dividend, right? Yes, you'll be having a preference dividend. You are raising, you are having the preference dividend here, you're deducting the preference dividend here. Now, earnings available for the equity shareholder. For the equity shareholder, what is the earning available after deduction of all these things? Okay, so now how will you get the particular share? These are for the all the shareholders. What now you want to know for one particular share? Earning per share. Okay, so what you will be doing, number of equity shares. So I have just said that you need to be calculating number of equity shares too. Okay, number of equity shares for the equity, complete equity, you'll be writing all the shares, number of shares, and for debt and prefer for all these things, number of shares, the shares will be there, the existing shares or the shares which you are raising will anyhow will be there. This cannot be zero, obviously. Okay, now EPS, you'll be dividing this earnings. Okay, earnings available to the equity share, you'll be dividing by equity shares, number of equity shares, you'll be getting the earning per share. You are getting earning per share here, right? Next is what we will, sometimes it happens that we'll be deciding on the basis of the EPS. It says in the exam, in the market, and this thing, you need to be calculating, your company policies will say that you need to be calculating capital structure based, depending on the earnings, EPS or MPS will be given. Okay, so what happens here, if you have to move further apart from the EPS, you need to be checking the price earning ratio of that particular company which you are calculating for. So price earning ratio will depend on price earning ratio will be different for company to company, and it also depends on the market current market. Okay, situations in the market. So you will be multiplying this EPS into this PE ratio, you will be getting the MPS, market price of the shares. Now it depends on your company's policy, as I said, or you have to be checking, right, which MPS is the highest. If this, then choose this. If this, then choose this. Okay, this combination. Okay, fine, what is the maximum? Suppose debt and equity combination is the best. Okay, this is the first priority. Next we will be giving to this thing, it depends on what you get. Actually, if you take an example in the numerical forms, you will get it. Okay, third option. So what you will be doing, will first go to this option row. Okay, fine, what capital structure I have to be following up? Debt and equity equally I have to be investing. Okay, that is the best and optimum, optimum EPS or MPS analysis. Sometimes it is very important to check EPS and MPS. Sometimes what happen, EPS of one company will be like EPS of one plan will be more than MPS of the other plan. Suppose, see, according to the MPS, this is the highest, right? But according to EPS, if you are checking out the EPS, this is to be, this EPS is high. Why it is? Because of the price earning ratio, that there's a change. Price earning ratio will be different for different alternatives, different for different markets. Okay, so you have to be very vigilant while calculating these things, and see how, on face, when you see the theoretical part, you cannot understand it. Okay, fine, I have to be taking a proportion in, but in what proportion and how, on what basis you have to be taking, which plan is best for the company? How will you decide? It depends on company, different companies too. Okay, how you will decide? Based on your EPS and MPS. We have done all the base of this thing, how to get what and what. Now we'll be checking out the illustration, like how this works. Okay, how these plans and all everything works. Let's see the illustration. Suppose that a firm has an all equity capital structure consisting of 1 lakh ordinary shares of rupees 10 per share. The firm wants to raise 2,50,000 to finance its investments, and is considering three alternative methods of financing to issue 25. The first method is to issue 25,000 ordinary shares at 10, that is nothing but 2,50,000. To borrow 2,50,000 and 8% interest rate, that is nothing but the debt. To issue 2,500 preference shares of rupees 100 each and 8% of dividend rate. If the firm's earning before interest and tax for additional investments are 3,12,500 and the tax rate is 50%, then find the effect on the earnings per share under the three financing alternatives. You need to find out what earning per share. What is happening here? Okay, per share. What is happening here? Okay, now let's read this question in a very, line by line thing. What it is saying, that a company is already having a capital structure of 1000, 1 lakh ordinary shares. Okay, that is of 10 rupees each. Okay, that firm wants to raise 2,50,000 new. They want to raise this new finance as an investment. Okay, considering three alternatives. They have three alternatives. They can directly raise 25,000 ordinary shares as 10 rupees each. Okay, directly equity shares. One option is that. Okay, that 2,50,000 will be from equity shares. Okay, next option is what? They can borrow that 2,50,000 completely at 8% rate of interest, right? Because it's already, existing firm. You're not raising all this you're raising all by loan. Okay, so that's fine, you have a base of the equity. So you are borrowing 2,50,000 rupees. Okay, at 8% interest, the fixed interest rate, the finance cost is 8%. Okay, now there's one more alternative, that is 2,500 preference shares of 100 each. Okay, each this thing, 2 lakh 50 into 100 is 2,50,000. Okay, you completely raising through preference shares at 8% or rate of dividend. Okay, now you'll be thinking that why it's given in that way, like both the things as 8% interest on preference and interest on the borrowings, right? But there's one difference that will, or that will really matter, that is the tax saving. If you are taking this, if you are taking the debt, if you're borrowing through the debt, then you will be saving the tax on it. Okay, if you are, issuing the preference dividend, there is no tax saving. Okay, so that's why even the percentage is same. You cannot just judge by on face unless and until you make the EBIT and EPS analysis. Okay, so we have to be finding only EPS. Okay, EPS under the three alternatives. So let's solve this problem. Okay, whenever you see an EBIT EPS problems, first what you need to do, you need to draw the particulars, and I am telling you, just check the questions, go through the question once and start writing all these things. Okay, it's the basic format that you need to follow anyhow. So what you have to be doing, you have to be writing this performer and keep your base ready. Okay, that's the best thing that you can save your time. You don't need to be thinking like you'll be writing EBIT and then thinking you'll be writing all, and then less the interest you'll be thinking and writing. No, first you make your performer, your base very much ready, and now you're just putting up the figures. Okay, so we'll be seeing that what is EBIT, what is the interest that we earning, that is, what is the profit, the operating profit that we are earning. Sometimes in the exam, EBIT is not directly given. It's said that you need to be calculating the EBIT from the sales, that variable cost. Okay, it may happen that you may also get the difficult, if you check out for the difficult level, that may also happen that they can ask this way. Otherwise, directly operating profit is already given, you need to be continuing from there. Okay, so what is it? EBIT. EBIT will be same in all the cases, obviously. So that is 3,12,500. Okay, so 3,12,500. 3,12,500. Okay. Next thing is that interest. Now let's see interest in equity. The option 1 in the plan 1, are we taking any loan? No. So there's no interest. But in plan 2, are we taking any interest? Yes. We are taking 8% interest on 2,50,000, right? So what will be the case here in 8% interest? What it will be? 20,000. How did you get the 20,000? 2,50,000. What amount you're raising into 8%. Okay, so your interest is 20,000. Okay, next is in preference thing. You're just raising from preference, right? You're not having any interest, any debt or loan, right? So no interest here. So what will be EBIT, earning before tax? It will be same for equity option. Herein you'll be deducting 20,000 from it. It will be 2,92,500, right? If you see. Okay, next herein it's the same amount, nothing is going off. Now what is given? What is more given about the tax? Tax is directly 50%. So 50% on what amount? 50% of EBT, earning before tax. So what you'll be doing? You'll be slashing this down. That is nothing but by half. That is nothing but 1,56,250. Okay, herein it will be 1,46,250. And herein the same thing, right? We have to deduct the tax by 50%. Okay, profit after tax is what? EBT minus EAT. Right away, because it's already 50%, other 50% will come down, right? 1,46,250. You're just deducting this amount with that. So 1,56,250. Okay, this is what we got, profit after tax. Now that is preference dividend. In option 1, do we have a preference dividend? No. In option 2, do we have it? No. In option 3, yeah, we are having the preference dividend. How much preference dividend? That is also an 8%. 8% in what? 8% in amount which we have raised as preference shares. So 8% on 2,50,000, that is nothing but 20,000 again. Okay, now let's see earnings available to the equity shareholder. The whole thing is available to equity shareholder herein. Okay, herein what amount is available? 1,46,250. What is the amount available to the equity shareholders herein? 1,36,250, right? So this is what the earnings available to the equity shareholders under 3 options. Now how many shares we are having at the end of the year if we are considering all the ventures into our this thing? Because we are considering all future endeavors here, so we will be taking the future shares issue of the shares, right? So herein we don't have interest, we don't have the dividend, we do have preference dividend, we do have how many increment of the shares, right? First of all, what is the basic outstanding existing shares? That is 1 lakh. No doubt it is 1 lakh. Okay, in all the cases it is 1 lakh already, right? Existing. But the special thing is that we are raising equity in this option. If we are raising an equity in this option, what will by how much amount of shares you're issuing? You're issuing 25,000 shares, right? So the total number of shares outstanding year end till the end of the year, if we are considering all the possibilities, 1,25,000. Okay, here end it is 1 lakh, here end it is 1 lakh. There's no change in the equity shares because we are getting that required amount from debt and preference respectively. Okay, so now EPS calculation, if EPS is as simple as that, nothing but earnings available to equity shareholders divided by outstanding shares. So this amount divided by this per share, 156,250 divided by 1,25,000. Let's use the calculator. Amount is the EPS is 1.25 rupee. Okay, for this thing it's very simple calculation. It is 1.46. This divided by this is 1.36. Okay, we are rounding it off. So this is the EPS. Okay, now you say me which EPS, which debt combination or which plan is better for this company, where you'll be getting the highest EPS. So this plan 2 is more profitable to the company if they take up. Okay, I hope I made this class very easy. If you really like my way of teaching, do subscribe my channel, do like it, share that with your friends. Take care guys, till then, bye bye, have a nice day.